Welcome, everyone. Good afternoon. My name is Matt Glova. I'm one of the certified financial planners here at LifeTime Asset Management. And we are fortunate enough today to talk to Heather Zack, who is going to be covering our webinar series with the topic of year-end charitable giving guidelines. So good stuff that we'll be hearing today and getting educated on. Before we get started, want to let you know that any questions that you have can be emailed now or immediately after to the email address info@lifetimeasset.com, and we will answer those questions if we receive them today while on the webinar, and if not, we can respond to you afterwards. But anything that you have, please send to info@lifetimeasset.com. And also noting that we are recording this session so that you can rewatch it as many times as you like and share it with friends and family, and we will get it posted to our website as soon as we can get all of the required edits and compliance approval and all that good stuff. So keep an eye out on our website for when that's completed. So I mentioned our speaker today is Heather Zack, who is the lead team of the Advanced Planning Department at Commonwealth. She's been with Commonwealth since 2011 and has been a resource for affiliated advisors on issues involving estate, charitable tax, and education planning. Heather has a JD from the University of San Diego with a concentration in corporate and securities law and a BS in business administration. She earned her LLM in taxation with a focus on estate planning from Boston University, and she is currently pursuing her master's in financial planning at Bentley University. She also holds her FINRA Series 7, 9, 10, and 63 securities licenses. So we can say that she is the smartest person on the presenting today for our webinar. And don't get too excited, Heather. You are the only presenter for this webinar, but you're still the smartest presenter. So, but we are very fortunate and lucky to have someone with your background on it and on this topic. And I think we were talking about this the other week when we were preparing for this, that I coincidentally was going through my Outlook inbox looking for an email, and I save a ton of emails, and I happened to come across your email from, I guess, probably 10 years ago when you started, 2011, and that your title at that time was like Service Center Associate or something along those lines. So it's amazing to see the progress that you've made over the last 9 or 10 years with the wonderful organization Commonwealth who we partner with. So without further ado, let's get started. Heather, thanks for being here today.
Thank you so much, Matt. I appreciate that. And I will tell you that I will watch this recording multiple times just for that intro. I'm feeling better than I have all week, so thank you so much.
Well, you are certainly welcome, and the topic is really timely. You know, given year-end charitable giving can be, you know, really a strategic financial planning tool, something that we talk to our clients about at this time of year. And given everything that's happened this year with the pandemic and everything else, it's important to keep this stuff front and center for people that are in need, and the most or the best strategies that we can use to utilize this from a tax perspective and a financial planning perspective. But in addition to that, you know, 2020 has been really unique with the CARES Act, and the CARES Act was passed earlier this year as a result of the pandemic and the unprecedented need for giving as a result of it. So Heather, it sounds like you've had some information that we need to consider regarding the CARES Act and in general some of the planning strategies that's been around for quite some time. So please take it away.
Perfect. Thank you again. And I do really want to say thanks to Matt, Sarah, Leslie, Christine, everybody at LifeTime for allowing me to come on today and chat with you all. My name is Heather Zack, and I am the team lead from the Advanced Planning Department at Commonwealth. So I work with Matt and his team pretty frequently on various financial planning subjects. But today I am here to talk about charitable planning opportunities. We are heading into the end of the year, which is also known as giving season. And some of the changes that have come about this year as a result of the CARES Act, which was passed early in the spring as a response to the coronavirus pandemic, we had some key charitable giving provisions within that legislation. So we'll be talking about that, as well as some of the common charitable giving vehicles that you might encounter. And then we'll wrap up with some of the, what I think are strategic charitable planning opportunities that might be beneficial for you as we're entering into year end. I am going to try to keep this fairly quick, and I'm going to go fairly high level, but we are going to be discussing some fairly technical tax and legal strategies. So don't hesitate to submit your questions or to follow up with Matt and his team after the call. So I want to start today with the CARES Act. And again, as I mentioned, the CARES Act did have some very specific charitable giving provisions, as Matt alluded to, because of the really unprecedented need for giving that has resulted from the COVID-19 pandemic. So a few of these notable provisions. Typically, if you are claiming the standard deduction when you're filing your income taxes, rather than itemizing, you won't see a direct impact to your income tax bill. We'll certainly feel the impact personally, but you won't feel an impact on your tax bill as a result of your charitable gifts. So given the significantly higher standard deduction that we have in place right now, which is $12,400 for an individual and $24,800 for a married couple, it may be the case that many of you are not itemizing. You're taking that standard deduction. So for this year, and so far for this year alone, we haven't seen any extension. The CARES Act is going to permit those individuals claiming the standard deduction to also take a $300 above the line deduction for cash gifts that go directly to a public charity. There has been some confusion and some question throughout the industry as to whether that deduction would actually be doubled for a married couple. But just last week or the week before, the IRS released its draft 2020-1040 instructions, and that seems to confirm that the deduction is limited to $300, even for a married couple filing jointly. When we get those final instructions, we may see some additional clarity, but as of now, we'll operate on the assumption that it is going to be a maximum of $300, regardless of your filing status. And notably, that above the line deduction isn't permitted for cash gifts to a donor-advised fund, which is something that we'll discuss in a little bit more detail later on in this presentation. For those of you who are actually itemizing your deductions, the CARES Act actually has an even more impactful change for 2020. So typically, the amount of charitable deduction that you can take in any given year is capped at a percentage of your adjusted gross income, or your AGI. I'll warn you, we're going to use a lot of alphabet soup today. So that cap is going to be based on two factors. First is the type of charity that the donation is made to. So that would be something like a public charity versus what we refer to as a private non-operating foundation, for example. The second factor is the type of asset donated, whether cash or some sort of long-term appreciated asset. So the cap for a donation of cash to a public charity has been set at 60% of AGI since the Tax Cuts and Jobs Act of 2017 was passed. And then the cap for donations of long-term appreciated assets has been set at 30%. So for 2020 alone, the CARES Act has removed that cap for cash gifts entirely. So that means that you could deduct 100% of your AGI for gifts of cash to a public charity, which could entirely eliminate your tax liability. Similarly, corporations are typically limited to deducting 10% of their taxable income for cash gifts, but that cap has been lifted to 25% for this year. And notably, for both individuals and corporations, any unused deduction can be carried forward for up to 5 years. So this can really provide some incredible planning opportunities that I will get into towards the end of this presentation. And again, here I want to point out that the AGI cap increase also doesn't apply to cash gifts made to a donor advised fund. And the cap for those gifts of appreciated assets, that 30% cap, has not changed as well. And then finally, one other element of the CARES Act that is not directly tied to charitable giving is that the CARES Act waived required minimum distributions, or RMDs, from your retirement accounts this year. Despite that fact, qualified charitable distributions are still permitted from your IRA account. So let's talk about what exactly a qualified charitable distribution is. So a qualified charitable distribution, or a QCD, another part of our alphabet soup, was made permanent as part of the tax law under 2015's Protecting Americans from Tax Hikes Act. And that was after that, that provision being routinely included in year-end tax legislation since about 2006. So a QCD permits IRA owners, including owners of an inherited IRA, to make tax-free distributions of up to $100,000 if those distributions are payable directly to a charity, meaning you can't take possession of those funds yourself and then give them to a charity. So despite the RMD age increasing to the age of 72 as a result of the Secure Act from last year, QCDs are still permitted beginning as early as age 70 and a half. And it is important to note that you have to have actually reached your 70 and a half birthday to be eligible. So you have to be exactly 70 in 6 months or older. And again, QCDs are permitted this year, even though required minimum distributions have been waived. So the biggest benefit of a qualified charitable distribution, particularly for those of you who've reached your RMD age, but you maybe don't have a need for your RMD for your retirement income, is the fact that a QCD can satisfy your RMD and is not a taxable distribution. So instead, the IRS treats a qualified charitable distribution as a tax-free rollover. And that income will not be reported as part of your adjusted gross income, which can have an impact on not only, of course, your tax bill, but also things like Medicare premiums and the taxation of your Social Security benefits. So if you're already giving to charity every year, utilizing a QCD can help you to really control your taxable income in retirement. And as with some of the other charitable giving provisions we've discussed, you may see a trend here. Qualified charitable distributions cannot go to a donor advised fund. So what the heck is a donor advised fund? A donor advised fund, or a DAF, is an account established through a sponsoring charity. Sometimes you're going to see these with big organizations like the United Way, but more often you're going to see them offered through an organization established solely for the purpose of providing these types of planned giving vehicles, or through financial institutions. So with a DAF, you're going to make an irrevocable gift to an account that is owned by that sponsoring organization. And you're able to name that account just as you would your own private family foundation. So I could have the Heather Zack Giving Fund. And then you can recommend charitable disbursements to charities of your choice thereafter. So because that DAF sponsoring organization is in and of itself a charity, you are eligible for an immediate upfront charitable deduction when you fund the account. Typically, there aren't going to be requirements to make grants of any size at any particular time, which contrasts with a private foundation where you have to distribute 5% per year. So you can really grow these assets over time and make gifts to your favorite charities over the years. So in order to ensure that your gift to the DAF sponsoring organization is a completed gift for the purposes of obtaining that charitable deduction, the DAF sponsoring organization isn't required to honor your grant requests, but in almost every case, they will. Ultimately, they just want to confirm that the charity that you're making a distribution to is indeed a public charity in good standing. So ultimately, in my opinion, a donor advised fund acts just as a private family foundation would, with much less expense. So you, your children, their children, and so on and so forth can keep adding funds to this account for generations ultimately, and then can decide together the charitable organizations that you want to support as a family. I've spoken with many clients and advisors that will actually have family meetings a couple of times per year and vote on organizations to make grants to from their donor advised fund. I've heard of a couple where children are actually creating PowerPoint presentations to make an argument for their favorite charity. So it's a really great vehicle for long-term charitable giving. And it's one of the most versatile and widely usable charitable giving vehicles out there. And I think it can have an application in almost any financial plan. So all that being said, now that we know what a DAF is, I want to talk about another planned charitable giving vehicle that might be beneficial to some of you, and that is a charitable remainder trust. So for those of you who might not be familiar with how a charitable remainder trust works, let me briefly explain the simplest of the many, many variations on a CRT, continuing our alphabets. So a charitable remainder trust is going to be funded with assets, whether cash or actual assets like securities or a property, and then is going to pay an income stream of either a fixed dollar amount or a percentage of the trust assets to a non-charitable beneficiary or beneficiaries for a term of years or for a lifetime. At the end of that income term, the remaining assets in the trust are distributed out to a charity. And I'd like to note that that charity could actually be your own donor advised fund. So you could almost get a double bang for your buck. You can create an income stream for yourself or your family members for life. And then any of the assets left in that trust would go into your own donor advised fund so that your family can continue to make charitable grants out of that account. The biggest benefit of a CRT is that the trust itself is considered to be a tax-exempt entity. So as a result, when you move assets into the trust, you're going to receive a charitable contribution deduction based on the present value of the remainder interest that's expected to pass to the charity at the end of that income term. And then if you contribute appreciated assets, such as investment assets, or as we'll get into shortly, closely held business interests, real estate, or collectibles, those assets can be sold in the trust without creating a tax liability to the trust itself, which is important to note, because that does not mean that those taxes are avoided entirely, which is a common misconception. So we're going to spend a couple minutes here talking tax, and I apologize, this might get a little bit dull for a moment, but bear with me. So while the CRT, as I mentioned, is in itself tax exempt, the distributions to the income beneficiary or beneficiaries are taxable based on a 4-tier accounting system used only by CRTs. So within the trust, there are going to be 4 main buckets of income that build up. First, ordinary income, then capital gains, then tax-free income, which would be something like municipal bond income, and then finally a return of your principal. So each year when the CRT goes to make its income distribution, it's first going to pull as much as possible from any accumulated ordinary income. So that would be taxable interest and dividends. And then once that ordinary income bucket is fully depleted, the trust will pull from capital gains and so on and so forth. So as a result, you or whoever you name as your income beneficiary can often spread out the tax liability on the sale of appreciated assets over several years, which typically results in paying a lower overall effective rate. So this type of strategy, as you may be able to tell, can be complex, and it definitely requires coordination with not only your advisor here at LifeTime, but also with your attorney and your tax advisor. So now that we've got an understanding of some of the changes in tax rules this year, as well as some of the common charitable giving vehicles, I want to dive into really the most important part of this presentation, which is some of the opportunities that you might want to consider as we head into the end of the year. So to start, that 100% of AGI cap that I was talking about earlier offers huge advantages to those of you who might be looking to fund large charitable gifts this year. So even though that 100% cap only applies to cash gifts directly to a charity, not to a donor advised fund, the IRS does permit taxpayers to actually combine different types of gifts. So essentially, if a donor maximizes their 30% AGI cap for gifts of appreciated assets, the 100% of AGI cap is going to be reduced by that amount and leaves the donor with the ability to deduct another 70% of his or her AGI with cash gifts. So let's walk through a quick example on that. Let's say, for example, that you have an expected AGI of $1 million this year due to a business sale. You could contribute up to $300,000 worth of low basis stock to a donor advised fund, and then up to $700,000 directly to charity to completely offset your income. Another way to look at this is you could do up to $300,000 of low basis stock to the DAF, another $300,000 in cash to the donor advised fund, which gets us up to that typical 60% of AGI cap, and then another $400,000 directly to charity, and you would again completely offset your income. I realize for most people that is probably a far-fetched example, given that generally we're not looking to give away all of our income in a year, but that 100% AGI cap does actually also have some more practical applications. So if you're experiencing a high income event this year, you can utilize that deduction to really mitigate the tax impact. Specifically, this could be a great year to execute a Roth conversion, so moving assets from your traditional IRA to a Roth IRA, along with a large charitable gift to manage the additional tax burden created by that conversion. And this is especially true because traditional IRAs are now much less attractive for beneficiaries to inherit after the Secure Act, given that most IRA beneficiaries will actually have to fully deplete their inherited IRA accounts within 10 years. So additionally, more of you might be exercising non-qualified stock options from your employers out of concern for market volatility, or, though we certainly hope not, you might have received a large lump sum severance package as a result of a layoff. More optimistically, perhaps you sold a business or you sold a vacation property this year. So in any of those cases, utilizing that charitable deduction could be very beneficial in managing taxable income. So for those of you who plan to give to charity this year, but you're not expecting to actually be giving 100% of your AGI, it might be beneficial to consider some of the planned giving vehicles we discussed today, like a donor advised fund or a charitable trust. And when you're considering charitable donations, don't limit yourself to considering only gifts of cash or investment assets. As I mentioned earlier, gifts of specialty assets can serve a great function within your financial plan. Gifting highly appreciated assets that you expect to sell sometime in the near future, such as a closely held business or a vacation or a rental property, might afford tax benefits in addition to satisfying your charitable giving needs. This can really unlock value within your financial plan to an asset that you may not have previously considered. It is again very important to note that there are rules around gifting these types of assets, and in particular, you can't already have a binding agreement to sell them. So if you've executed a purchase and sale on your vacation property, it's probably too late to consider a contribution to a charitable giving vehicle. In addition, gifts of other tangible assets like collectibles such as art, wine, or stamps, all of which can be given to charity, have their own special set of rules. So again, you'll want to work closely with your advisor, your attorney, and your accountant when structuring these gifts. And lastly, another specialty asset of sorts that many individuals really don't consider giving to charity is their IRA balance. So as I've alluded to a couple of times here, traditional IRAs are much less attractive to inherit after the Secure Act from the end of last year. Because again, it's going to require most beneficiaries to withdraw all of the IRA assets within 10 years of inheriting it. Whereas in the past, most beneficiaries could stretch distributions over their lifetime, therefore spreading out the tax liability. So one popular planning strategy since the passage of the Secure Act involves naming a charitable remainder trust, which we just talked about, as beneficiary of your IRA, with your children named as the income beneficiaries on that CRT. So this way, your children can simulate a stretch distribution through the income distribution from the CRT. Now, this strategy is definitely not appropriate for everyone. There are added costs to drafting and maintaining a trust. So it probably isn't appropriate if you have smaller IRA balances. And then additionally, you have to be comfortable knowing that at least some of your IRA assets are eventually going to pass to charity, rather than the entirety of those balances going to your children or other family members or beneficiaries. So ultimately, the goal of our presentation today was really to just get you thinking about ways to give other than simply writing a check to your favorite organizations. Certainly is a great way to give, and charities absolutely appreciate it, but there are more strategic ways to bring charitable giving into your financial plan. The team here at LifeTime will absolutely be a valuable resource in determining whether any one of these strategies might be appropriate for you and for your financial plan. So with that, I will open it up to questions. And Matt, if you want to take the reins.
Yeah, thank you so much. Let me switch screens here and share, and hopefully you still see the same questions slide. Okay. We do have some information or some questions. First, we can't thank you enough for this valuable information. It's been very important to go through some of this information, and I'm sure as laws always change, we'll need you to come back in the future.
I'll be happy to do it.
The Secure Act at the end of last year had some significant changes to the overall tax code and some other items, and then of course the CARES Act, like Heather mentioned as well. So we'll continue to get information out regarding any changes that we see. So we do have a couple of questions regarding some of this information. One question that I have, is there any, has there been any talks in Congress or about changing the rule of getting QCDs allowable to go to a DAF? I thought maybe at one point I heard that may be an option, but I haven't heard anything in a couple of years, it seems like.
Yeah, it's definitely been addressed a couple of times. I think there have been attempts to include that as an eligible recipient for a qualified charitable distribution. No traction on that thus far. I would hope that we may see that eventually, but I think the intent behind this legislation from the congressional point of view, I can step into the mind of Congress for a moment, was really to try and actually get money into the hands of these charities. And the Donor Advised Fund is really great for our planning purposes. For charities, it's a little bit tough because they can't expect when they might or if they will receive assets. So we'll see. Everything is up in the air, but as of right now, still no movement on a QCD to a DAF.
Okay. Regarding year-end giving or tax management, how do we take advantage of bunching charitable contributions? Not sure if this is done and if it's legal. That was a question we had come in earlier.
Yes, that is a great question and a fantastic strategy. So the idea of bunching is, as I was talking about, because the standard deduction is so much higher now, we're at that $24,800 threshold for a married couple. If you are not giving in excess of that, or if your total itemized deduction, so mortgage interest, state and local taxes, charitable deductions, those are really the big ones. If you are not going to cross that $24,800 threshold, you're not going to feel any benefit from your charitable giving. So the idea of bunching is, if you have the cash flow to do this, you could bunch, let's say, 5 years worth of your charitable gifts that you're going to be making out to your church or other organizations. Put that into a donor advised fund. So let's say we do, 5 years worth of $5,000 gifts. We've now made a charitable contribution to a donor advised fund of $25,000, therefore getting us above that standard deduction, so that this year we can really feel the impact of that charitable gift on our bottom line. And then for the next 4 years, we'll just give those gifts directly out of our donor advised fund rather than writing a check. So great way, definitely legal. And it's just a way to really capitalize on the itemized deduction.
And that is probably one of the cheaper strategies to implement, given there's not really a need to draft in a trust or get an attorney to involved with it.
Yeah, a donor advised fund is incredibly easy to open. You can usually get one open within a week, open and funded, very, very low cost. So it's, we see the bulk of donor advised fund accounts being opened between Thanksgiving and New Year's, because a lot of folks at that point are doing their year-end tax planning and realize, we need to get some itemized deductions going. So let's park some money in a donor advised fund. And we'll figure out where that money's going later.
And with some of these other strategies, what is, if you can answer this, even a typical profile of a client or someone thinking about doing this, from a financial standpoint, from a net worth or cash flow or investable assets for either a charitable remainder trust or a donor advised fund, if you can answer that.
Yeah, so personally, I think a donor advised fund could fit in any budget, really. So any net worth. We have Mark Zuckerberg funded a donor advised fund with multiple tens of millions of dollars, but you can open up a donor advised fund in some cases with as little as a few $100s. Usually you're looking at a minimum of about 5,000. That's the case here at Commonwealth. So a DAF, the metrics around that really I think could be for anyone. When you start getting into charitable trusts, whether charitable remainder trusts or charitable lead trusts, which we didn't get into today, because of the cost of having an attorney actually draw up those documents, as well as the tax reporting required, you may need a trustee that you're going to pay a fee for. I don't recommend exploring a charitable trust unless you're looking to fund it with, at a bare minimum, probably about 300,000. I think it really starts to make sense for gifts of 500,000 or above. And the big idea with any sort of charitable trust, whether remainder or lead, is that it is an irrevocable gift. Same with a donor advised fund. With a charitable remainder trust, you are able to potentially pull an income stream off of that, but you have to be comfortable with the fact that these assets are now out of your control, and therefore you wouldn't want to put a significant portion of your overall net worth into that trust, just so that you have some additional liquidity. And then just on a qualified charitable distribution as well, since we touched on those today, again, there, I think it could make sense for just about anyone. In my eyes, if you are making charitable gifts and you are of the age that you have to take an RMD, or you're 70 and a half at the very least, you might as well consider making that gift out of your IRA. Therefore, you're managing some of your taxable income. You're preserving maybe some of your non-retirement assets that have favorable tax treatment for yourself and for other generations. So I think that could be a fit for anyone as well.
Okay, that makes sense. The last question is, and again, it's kind of up in the air on still what's going on based on what's going on this week, and that's, if there is a projected Biden win and potentially a split Congress, which looks like there will be. Is there anything in his agenda, the new administration agenda, that should be that we should keep an eye out for that could be timely? Any changes in the tax code or the estate plan that people may need to implement or think about now versus next year?
Yeah, so that's a great question, and it's one that we're facing a lot from advisors, from clients, from really everyone. The election is, of course, top of mind. I just took a quick peek to see if we've had a decision yet. Doesn't look like we have. But even assuming, but before I get into the specifics there, even assuming that there is a Biden win, the Senate control is up in the air right now as well, but let's say that there is a full blue sweep across both the White House and Congress. Even if that is the case, first of all, I think the coronavirus is going to be the very first focus of any administration at the beginning of next year, come January. So the likelihood that we would see any tax legislation, any meaningful tax legislation passed in 2021, at best would probably be the later end of the year. When that happens, it would be very contrary to everything I know from history here, that would be applied retroactively. It would be overly burdensome to the taxpayers to make a midstream shift to a new tax law and say this is going to apply either retroactively from January 1st on, or even for the remainder of the year. It would create a bookkeeping nightmare. It would be very difficult administratively. So most likely, and of course, again, we never know for sure what's going to happen in Washington. I will couch this. More than likely, even if we see sweeping tax reform come through next year, it likely will not go into effect until 2022, and that's if we even get to it. So I'll lay that groundwork first. The Biden tax plan, I think, most notably in this conversation, really is going to repeal a lot of what was done under Tax Cuts and Jobs Act. So we're going to see the top tax bracket potentially raised back up. There is some talk of eliminating the favorable capital gains tax treatment for individuals with an AGI of over $1 million, I believe is the number. And then one of the biggest points is the estate tax exemption, which is currently sitting around $11.58 million, would be brought back down to pre-Tax Cuts and Jobs Act levels. So probably somewhere in the neighborhood of $6 million. And there may be an elimination of what we call the step up in basis. So under current tax law, as has been the case for quite a long time, with a brief exception, when an individual passes away, any assets that are included in their gross estate, their gross taxable estate, are able to get a basis adjustment. So whatever the fair market value of that asset is on the individual's date of death becomes the cost basis for the person that inherits that asset. So the Biden tax plan has proposed eliminating that basis adjustment, that step up in basis, which would have some pretty significant planning implications. I don't think any of this warrants planning today, because again, I think at best we would be looking at some of this implemented in 2022. But if everything goes through as proposed, which is highly unlikely, I think using some of these charitable giving vehicles is going to be even more meaningful. So if you have assets that would have typically gotten a step up in basis, putting them into something like a CRT where the tax liability can be spread out over a number of years could be really beneficial to your heirs. Similarly, using any technique where you're shifting assets outside of your estate, if you are going to have an estate tax concern, could be beneficial. And if you are philanthropic, using a charitable giving vehicle to do that certainly makes sense. So a long-winded answer to who knows what's going to happen. I wouldn't panic right now. I would not do any panic planning for the next month and a half. Wait and see what happens come 2021, if anything.
Yes, and with any changes that come about, we'll certainly keep our clients abreast of all of that, and bring you back if needed to address any advanced planning ideas. And for all those that are on the call, we have our newly minted LifeTime Tax Management Department to help out with a lot of these strategies as well for year-end tax planning, alongside with our Lifetime Asset Management team. So Heather, just want to thank you again for really taking the time to go through this important information. We do have more webinars coming up for those that are interested in cybersecurity. We have that one as our next webinar, and then after that is going to be year-end tax planning with a CPA from our tax department going through that. We want to thank Heather again for her expertise, and as a reminder, the recording will come out shortly and be posted on the website. Make sure you get a copy of that, Heather, so you can share it with your entire team. But I hope everyone stays safe out there, and again, reach out to us at info@lifetimeasset.com if you have any questions. Thanks again, Heather.
Thank you. It was great to be here.